Today we will talk about Chapter 3, Issues of Budgeting and Control. Introduction to this chapter. The main purpose of Chapter 3 is to provide an overview of budgets and the budgeting process in order to establish a basis for appreciating the relationship between budgeting and accounting. What are the key purposes of budget? Our first point in this chapter is to explain what are the objectives of budget. Any budget are intended to carry out at least three broad functions: planning, controlling, and reporting. So, function number one of any budget is planning. Planning is concerned with specifying the type, the quantity, and quality of service that the government provides, and estimating its cost and determining how to pay for it. Function number two of any budget is controlling. Budget should help to assure that resources are obtained and spent or expended as planned. Function number three of any budget is reporting and evaluating. Budget lays the foundation for end-of-year reports and evaluation. In other words, budget to actual comparison reveal whether revenue and spending mandates were carried out. So, the three key functions of any budget is planning, function number one, controlling, function number two, reporting and evaluating, function number three. Second point in this chapter is what are the types of budget, or why is more than one type of budget is necessary or required. The benefits of budget or budgetary process can be fully achieved by only one single type of budget, which means a well-managed government should prepare budget for varying periods of time for or from multiple perspectives. In other words, well-managed government need more than one single type of budget, need multiple budgets. These budgets include appropriation budget, capital budget, flexible budget. In addition, many government and not-for-profit prepare performance budget, which means we need more than one type of budget. Each budget is made for certain purpose. First type of budget is appropriation budget. Appropriation budget is concerned mainly with current operating revenue and expenditure. Appropriation budget determines the amount of taxes and other revenue that must be generated in order to cover expenditure. So, operating budget, which covers general fund, is always an appropriation budget, as it incorporating expenditure along with estimated revenue. Second type of budget is called capital budget. Capital budget focus on the acquisition and construction of long-term assets. Capital budget generally financed through long-term debt rather than taxes of a single year as in appropriation budget. Capital budget, in contrast to appropriation budget, typically covers multiple years. So, appropriation budget financed through taxes covers only one single year, while capital budget financed through long-term debt and cover multiple years. Also, capital budget is a plan setting forth when specific capital asset will be acquired and how they will be financed. Also, very important note is that capital budget are tied to operating budget, and that current year capital spending will be included in operating budget. Again, the very important point is that what is the relation between capital budget and operating budget? capital budget are tied to operating budget and that current year capital spending will be included in operating budget. The third type of budget is flexible budget. Flexible budget is intended to help control costs, especially those of business type activities. So flexible budgets are related to business type activities. Fourth type of budget is performance budget. Why performance budget are required? What is the importance of performance budget? The traditional and most commonly prepared budget is referred to as an object classification budget. What is object classification budget? You have to note that object classification budget is one way to classify expenditure within budget or inside budget. That include other ways such as classifying budget by fund, by organizational units, by function or program, by activities, or by character. So fund or organizational unit or function or program or activity or character is a way to classify expenditure inside the budget. We know that budget has two main sides, expenditure and revenue. One way to classify expenditure is object classification. We have other ways such as fund, organizational unit, function, program, activity, and character. However, the most commonly way to classify expenditure in budget is object classification budget. However, the main virtue of object classification budget is that it facilitates control as it established rigid spending mandates. But these strengths have many shortcomings. What are the main shortcomings of object classification budget? We have 4 shortcomings of object classification budget or criticism of object classification budget. Number 1, an object classification budget discourages planning, as it focuses on a specific item rather than an overall entity, objective, strategies, and other performance targets. For example, officials of a school district may focus on increasing salaries, supplies, while failing to consider additional outlays that focus on or affect the primary educational mission of the school. So, object classification budget discourages planning as it focuses on a specific item rather than the overall entity mission or objective. Second criticism or shortcoming of object classification budget is that it promotes bottom-up rather than top-level budgeting or planning, as it unit in government presenting its fiscal requirement for approval in absence of any coordination between goals and strategies between governmental units. Third shortcoming of object classification budget is that it overwhelms top-level decision maker with many details. Shortcoming number 4 of object classification budget is that it limits post-budget evaluation. Due to all these shortcomings or criticism, performance budget have been adopted in place of or as a supplement to object classification budget, as performance budget focus on measurable units of effort, service, and accomplishment. For example, improving water quality or education quality, which means the overall or the main objective rather than specific goals. The most common type of performance budget are program budget, where resources are identified within program rather than traditional organizational units, and expenditure are categorized by activity rather than by object. On what basis of accounting are budgets prepared? Governmental Accounting Standard Board and Financial Accounting Standard Board established generally accepted principle only for financial reporting, not for budgeting. So GASP and FASB establish the generally accepted accounting principle for financial reporting. Who established the principle for budget? Budgetary principles are established either by organization or government that supervise them. So, GASP and FASB established the principle for financial reporting, while other organization or government established principle for budget. For example, states may establish the principle for their cities, towns, and districts. So we have to differentiate between these 2 points. GASP and FASB establish principle for financial reporting, while government established principle for budgetary process. Although it lacks the authority to establish the standard for budget, Governmental Accounting Standard Board established some recommendation that help government how to prepare their annual budget. This recommendation recommends that government should prepare their annual budget on the modified accrual basis. Again, we know that GASP and FASB established standard or principle for financial reporting, not for budget. However, GASP established or issued some recommendation that help government in preparing their annual budget. This recommendation recommend that government should prepare their annual budget on the modified accrual basis, which is the same basis that or they are required for reporting on the governmental fund in their external financial statement. However, the modified accrual basis does not allow for balance sheet recognition of long-term assets and long-term debts. We mentioned that in chapter 2. We mentioned that modified accrual basis does not allow recognition of long-term assets and long-term debts in balance sheet. However, modified accrual basis permits a wide array of transactions and events to be recognized when they have substantive economic impact, not just merely when they result in cash inflow and outflow. However, many governments reject the Governmental Accounting Standard Board advice that recommend them to use modified accrual basis. So what are the bases that government rely on when preparing annual budget? So they prepare their budget on cash basis or slightly modified cash basis. Again, government reject GASP advice. Government reject GASP advice. GASP advise government to use modified accrual basis, while government reject this advice or this recommendation. Instead, they prepare their annual budget on cash basis or on slightly modified cash basis. Government that budget on cash basis assign revenue and expenditure to the period in which government is expected to receive or disperse cash. Again, GASB recommend government to use modified accrual basis, and we mentioned that in chapter 2 modified accrual basis does not allow recognition of long-term assets and long-term liabilities. However, it provides a wide array of transactions and events to be recognized. So government reject their advice, reject the GASB advice. Instead, they prepare their annual budget on cash basis or slightly modified cash basis. However, some government modify the cash basis by requiring that encumbrances to be accounted for as if they were equivalent to actual purchases. What is the meaning of encumbrances? Encumbrances is a commitment to purchase goods and service in the near future. Again, encumbrances is a commitment to purchase goods and service in the near future. Some government that reject the GASB advice and instead of modified accrual basis use cash basis, they modify the cash basis by requiring that or by dealing with encumbrances as if they were equivalent to actual purchases, which means encumbrances is like an actual purchase. As we know that cash basis assign revenue and expenditure to the period in which government is expected to receive or disperse cash, and encumbrances is a commitment to purchase goods and services in the future, not actual purchase. However, government deal with encumbrances as if it's equivalent to actual purchases, so they need to modify cash basis. So government modify cash basis by dealing with encumbrances as it actual purchases. So what is the shortcoming of cash basis, or what is the adverse consequences or criticism of cash basis? Cash basis has 4 adverse consequences or adverse shortcoming. Number 1, cash basis distort the economic impact of government planned activities. Number 2, a budget that is balanced on cash basis may be unbalanced to economic cost and revenue. Number 3, cash basis permit a government to balance its budget by delaying cash disbursement and advance cash receipt. Again, cash basis permit government to balance its budget by delaying cash disbursement or expended and advance cash receipt. Last point, on the revenue side, comparable scheme works equally well, advancing or delaying the due date of tax or fees. How to budgets enhance control. Owing to the adverse consequences of violating budgetary mandates, most government build safeguards into their accounting system that help assure budgetary compliance. These safeguards include preparing journal entries to record the budget. So the basic box of account include journal, in which journal entries are recorded, and ledger, in which all balance sheet and operating accounts are maintained. Of course, general ledger consists of control account that summarize the balances of the detailed subsidiary account. As in ledger for a business, each account consists of 3 columns. 1 column for debit, second column for credit, and third column for balance, which is the difference between the debit and the credit. However, the ledger account in government is a little bit different. The ledger account of government includes 4 columns, not just 3 columns. The ledger account of government incorporates a budgetary control feature that's not found in business. In other words, the ledger account for example, a revenue incorporates additional debt column, which is called estimated revenue. The estimated revenue debit account, the difference between estimated revenue, which is debit, and actual revenue, which is credit, equal the amount of budget revenue still to be recognized. For example, the government budgeted real tax property revenue for approximately $15 million. So the estimated revenue from real tax property is approximately $15 million. And recognized from the estimated revenue about $3.9 million up to date, which means that there is $11.1 million still or remain to be recognized. So the estimated revenue from real tax or real property tax about $15 million. The government till now just recognized $3.9 million, which means the actual revenue till now is $3.9 million, which means the government still has $11.9 million remain to be recognized. So the difference is still to be recognized. Similarly, the ledger account for expenditure incorporates 2 extra columns, not just only 1 column as for revenue. These 2 extra columns, the first one for appropriation. Appropriation means expected expenditure. Appropriation means expected expenditure, and this account is credit. In this column, government posts a credit for the amount appropriated per the budget. So appropriation means expected expenditure. The second column for encumbrances. Encumbrances is a commitment to purchase goods and service in the near future. Encumbrances is a debit. The difference between appropriation credit account, which is expected expenditure, and encumbrances, we deal with encumbrances as if it's actual expenditure, and the actual expenditure equal to the amount of appropriation that is still uncommitted and is therefore available to be spent, which means unencumbered balance. So the ledger account for expenditure incorporates 2 extra columns. 1 column for appropriation, which is a credit account. Appropriation means expected expenditure. Another column for encumbrances, which is debit account, and encumbrances means commitment to purchase goods and service in the near future. For example, this account indicates that the government appropriated $300,000 for the water lab, which means the government has estimated expenditure or appropriation of $300,000. To date or till now, the government spent $120, which means the actual expenditure is $120. The government also has an outstanding commitment for goods and service of $15,000, which means an encumbrances of $15,000. Again, the government has an appropriation or estimated expenditure for the coming year equal $300,000. Till now, the government spent 120, which means the actual expenditure is 120 of or out of 300,000. The government has also an encumbrance, which a commitment to purchase goods and services in the near future of 15,000. This means that the unencumbered balance equal 165 available for future spending. Again, estimated expenditure is 300,000. Actual expenditure is 120 and encumbrances of 15, which means we have 165 of available for future spending. So expenditure, the ledger for expenditure has two extra columns, one for appropriation, which means it's expected expenditure, another column for encumbrances, which is commitment to purchase goods and services in the near future. However, the ledger for revenue include only one extra column for estimated revenue. Thank you.